Imagine amplifying your trading gains in the fast-paced crypto market, where every move can be exhilarating. But with that power comes a critical question. How do you prevent losing everything when prices turn against you? Understanding this is key to smart leveraged trading. The core formula to calculate the liquidation price for a leveraged long position involves your entry price, the initial margin rate, maintenance margin rate, and your chosen leverage. Simply put, it determines the price point at which your collateral is no longer sufficient to cover potential losses, and your position is automatically closed by the exchange. This calculation isn't arbitrary. It is driven by the exchange's risk management protocols, specifically the maintenance margin requirement. The maintenance margin is the minimum equity percentage you must hold in your account to keep a leveraged position open. When the market price drops to a point where your equity falls below this threshold, the exchange liquidates your position to prevent your losses from exceeding your collateral and impacting the exchange's solvency. Factors like funding rates and fees also slightly influence this calculation over time. To calculate this price, you generally start with your entry price, then subtract a value derived from your initial margin and the maintenance margin. A common simplified formula for an isolated margin long position is liquidation price equals entry price multiplied by 1 minus the initial margin ratio minus the maintenance margin ratio. For example, if your entry price is $100, initial margin is 10%, and maintenance margin is 5%, the calculation helps pinpoint that critical level. Many exchanges also provide built-in calculators, so learn how to use yours effectively, paying close attention to any additional fees that might slightly adjust the final number. A key insider detail to remember is the difference between isolated and cross-margin. Isolated margin means only the capital allocated to that specific position is at risk for liquidation, while cross-margin uses your entire account balance as collateral, meaning a liquidation event could wipe out your whole portfolio. Knowing which type of margin you are using significantly impacts your personal risk profile and the true liquidation dynamics. Ultimately, grasping this formula and the factors behind it empowers you to set more informed stop-loss orders, manage your risk exposure effectively, and avoid sudden, unwelcome surprises in your leveraged trading journey. It transforms liquidation from a feared event into a calculated risk, allowing you to trade with greater confidence and strategic foresight.